All right. Today's Thursday, the 12th of December. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. You know what's really interesting about today's session? And again, I love all of you folks, especially those of you who participate on Discord, because it gives us a little bit of a pulse on the sentiment of what people are thinking about the market and all of that. You go back to yesterday's session. What was the sentiment by the majority? You see, now we got the CPI low and they're going to pump the market higher. Let me buy some calls on Apple, calls on Nvidia, calls on this. And today we open with a hotter PPI and we go down instead. And what happens today? Okay, maybe we're going to pull back and yesterday was a fake. And let me buy some puts on this, some puts on that. And then next thing you know, AVGO comes out after the bell and pumps at least the NASDAQ for now higher. So you're getting your head chopped off day after day, chasing the day-on-day movement. The best approach right now is to ask yourself, what do you see comes January? What do you see comes February? And place your trades based on that, not the day-to-day activities. Because, it's Christmas time. You don't want to declare bankruptcy right now. At least wait till next year. But with that note out of the way, folks, let's begin the program here by the headlines of the day. We begin with the PPI. So yesterday we got the CPI and it was again moving up. CPI rises 2.7%. That's the cooked data, of course. In reality, it is much higher, but even the cooked is not good. Here comes the PPI, which is the leading indicator for the CPI. And here's the headline for you. Wholesales prices rose 0.4% in November, more than expected. Details? PPI is red hot. 0.4%, the expectations 0.2%. So this is double the estimate. PPI core as expected. Year on year, PPI 3.4%. Expectations 3.2%, so hotter. PPI core year on year 3%. Expectations 2.6%. That's a disaster. The Federal Reserve says that my target is 2%. Well, PPI year on year 3.4%. PPI core 3%. Moving higher now. Why is the Federal Reserve chairman cutting rates again? The short answer to that is he doesn't know what the fuck he's doing. And I'm going to prove it to you by the end of this segment. But let's read more data here because the revisions are even more disastrous than the actual reading. The Kubisi letter says breaking. The U.S. Bureau of Labor Kitchen Statistics has revised October PPI inflation higher from 2.4 to 2.6. Also, core PPI inflation for October has been revised higher from 3.1 to 3.4%. This means that 6 out of the last 7 PPI inflation reports have been now revised higher. And imagine if we were actually getting the actual ratings of inflation, the CPI, if there was no cooking. With today's 3% PPI inflation print, PPI inflation is now at the highest level since February of 2023. CPI, PPI, and PCE inflation are all officially back on the rise in the United States. What is happening here? ? What's happening here is a disaster in the making. And the remedy to that, you will see yields making new highs. If this doesn't stop, you will see bond yields in the longer end making new highs. And that's going to be an absolute devastation to the economy. Look at the chart right here. You can see the trend year on year in the PPI, just like we covered back in the CPI yesterday. You see the trend now moving back up. So we're in the beginning stages of reinflation. Usually reinflation, also known as the second wave of inflation that usually happens, case in point, the 1970s. Usually it is more aggressive, more devastating to the economy than the first wave. Why? 2 reasons. Expectations are already molded that we have inflation in the economy. So if you have a second wave, the rate of inflation becomes more aggressive. Number 2, there has been already damage in the economy by the first wave. You get a second wave, it's fatality. Goodbye. Bear in mind, CPI, PPI, PCE, all going higher. But maybe they're going higher because the economy is doing hotter than ever before. We're creating jobs all over the place. The consumer is spending all over the place. Not really. Here's the other headline for you. Only 16% of holiday shoppers plan to spend more this season because of inflation. So the consumer is getting weaker by the day. And we're going to go back, folks, to the duality of the risk, which again, this channel was the first to even talk about that. We did that over a year ago. We've been talking about the duality of the risk, which is right now you're on a tightrope. You have your inflation wind, your inflation risk, You got your recession wind, your recession risk. You're gonna get knocked out one way or the other. Walking the tightrope, aka the soft landing, is not sustainable, never sustainable. You're either gonna get knocked out by the inflation wind, that's devastating because the recession will come thereafter, but it comes more aggressive if you have a reinflation episode. And this is why we said from the beginning, accept a mild recession while the economy's fundamentals are still okay. Reduce the inflationary psychology, eradicate, I should say, the inflationary psychology out of the economy, and then we'll be back on our feet again. The stock market will go sure 35% to the downside, but that's the price to eradicating inflation. The Federal Reserve said no. The Federal Reserve said no, we're going to rescue equities and risk reinflation. And they insist on being wrong. And by the way, the son of a bitch Powell, he's obsessed with this channel, at least in 22, before we went private. And I'm not making this up, okay? This is from reliable information. Now, of course, the guy has a net worth of $300 million, right? But he doesn't want to pay the $10 to watch my show. Probably not because of that, but because he's embarrassed if he gets caught paying me. So he has a proxy account to watch this channel. And Mr. Powell, if you're watching, here's one for you. But Mr. Powell agrees with the Maverick of Wall Street. He says, this is the latest interview that he did. The title is The Economic Tightrope. And even JP acknowledges and agrees with me that we're right now walking the tightrope and we have that duality of the risk, inflation and a recession. And he thinks that somehow he's going to balance things out and keep us walking in the rope until the inflation and recession winds are over, which they're never going to be. But then at the same time, he admits that he's looking at lagging data. So you cannot really ensure that the economy will continue to walk on the tightrope and not get knocked down by the inflation wind or the recession wind if you're looking at lagging data, not the trends that we look at in this channel. And notice in the speech, you'll hear it in a second, he says, in September we cut rates, but then turns out the data is actually stronger than we expected. Okay, so is that an admission that you made a mistake? And if you did, why are you going to cut rates again in this upcoming meeting in December? Take a look.
I mean, more broadly, there are two risks, right? There's the risk that we move too quickly and undermine the progress we've made on inflation, and there's the risk that we move too slowly and unnecessarily undermine the labor market. And we're trying to be in that middle place and get it just right so that we continue to get inflation coming down. We keep policy at a restrictive level, but at a less restrictive level over time. That's what we're trying to do. I would say in September, it was time for us to cut because it was time, but also because I wanted to send, and we wanted to send a strong signal that we were going to support the labor market if it continued to weaken. What happened instead was, in the couple of months after that, we got some data revisions which strongly suggested that the economy is even stronger than we thought, even stronger than we thought. So the picture is actually stronger.
So again, the guy doesn't know what he's talking about, and this is why we're going to head into a disaster. I mean, he feels really confident right now and arrogant and cocky, but yeah, the market is higher and inflation went down and nothing happened. But this coward, he's now counting the time, minute by minute, and despite what he says, he actually wishes that he could get fired by Trump because he doesn't want to assume the responsibility of what's going to happen to the economy later based on his rotten actions. He wants his term to be over, and then the crash and the recession happens. So he says, yeah, see, I was holding things pretty good. No. You're a criminal. You're the biggest disaster that ever happened to the economy of this country. All you have to do is just the home affordability, which will get worse and worse by the day. By the time everything crashes down, you'll be so broke, you'll be begging for a slice of toast and some beans just to survive. Forget about buying homes. But here's what you need to understand about the dynamics of what's going to happen. See, when we talk about you want to trade the day-to-day, good luck to you. You might get lucky and make a little bit of money. Then you run into one bad trade and you go kaput, right? We all know that kind of journey. But if you're going to position yourself for a longer term, say from an investor standpoint, the people who actually survive and stay in the market, not the gamblers who come and go, this is what you need to understand. So the Federal Reserve cuts rates because, let's backtrack a little bit here. Folks say the Fed is cutting rate. Why is the dollar going higher? Why are bond yields going higher? Pay attention now. This is the critical information I'm talking about. The Fed cuts rates. What does that do? At least according to the bond market. It says that by cutting rates, you're increasing the inflation risk. And the bond market and the dollar says, you know what? We're going to go higher because we're trying to fix your mess. We're trying to send a signal here that every time you cut, you're increasing the inflation risk. And this is why we predict in the future that you're going to be tighter, if not even hike rates again. And that's why the dollar and bond yields go higher. In the past, or we're accustomed to, the Fed cuts rates, all of bond yields go down, the dollar goes down, but now the dynamic is different because the mentality in the bond market is every time the Federal Reserve cuts rates, they're increasing the inflation risk, and you're seeing it right now, folks. The early indicators, CPI stopped going down, PPI coming back up higher. Okay, what happens when we have the dollar and bond yields going higher as we see right now? Well, the dollar going higher is going to knock down commodities, so we see commodities going down. And with yields going higher, we see risk assets going down. Right now, you're seeing a stupidity bubble in some of these risk assets, but we're talking about the small caps, the profitous companies. They're not really participating that much, and everybody who's participating in them will get their heads chopped off. That's a promise. But this is the dynamic. Dollar goes higher, yields go higher. You see commodities and risk assets down. What is the end effect of all of that? Headline inflation goes down, or at least stays down. It behaves because commodities are not rising. Oil is not shooting up higher. Metals are going down because the dollar is going higher. So you might look at this and say, but Maverick, isn't this pretty good? That the Fed cuts rates and inflation goes down either way because the dollar and bond yields go higher? Hold your horses. Because there is another dynamic when the Federal Reserve cuts rates. The borrowing rate goes down. Your evidence to that is the lower end of the yield curve. The notes, the bills, all the way to the 1 to 2 year bond yields. Those are actually going down. They're not going higher, like the 30 and the 10, the longer end of the yield curve. What happens when the borrowing rate go down? Well, you see a lot of gambling. We see a lot of margin inflows into stocks because now it's cheaper to borrow and buy stocks. So we see the indices going higher. We see the big caps outperforming, not the stuff that is sensitive to the dollar or bond yields. Those have been lagging. What happens when you have all of this margin inflows into stocks and the indices go higher? Retirement accounts begin to go higher, pensions, and everybody begins to feel rich. The wealth effect goes higher. What happens when the wealth effect goes higher? Folks begin to spend on traveling and spending on services, right? So what happens? Core inflation goes higher. And this is the dynamic that we have right now, where headline inflation is behaving, but core is the bigger problem. Here's the important thing you need to watch out for 25. What happens if we introduce the orange man? Once the orange man gets into this equation, what is he going to do? He's going to do tax cuts. And when tax cuts happen, when we have an insane budget deficit right now, look at this trend right here. The fiscal 25 already began, and we're already down $624 billion. So the deficit here could be well over $3.5–4 trillion. If he passes the tax cuts, the deficit could go to $4 or $5 trillion. And you could talk about Doge. They're going to cut spending. Doge is a fucking scam, okay? It's a gimmick by Elon Musk and Ramaswamy and all of that. If Doge is serious, they're going to cut defense spending. They're going to cut Social Security and healthcare. They're not going to do any of that. Okay, when we get the tax cuts, what happens to the dollar with increasing the budget deficit? Well, the dollar begins to go down now. What happens? And by the way, yields continue to go higher because the budget deficit means higher borrowing costs. So yields continue to go higher, but the dollar goes down. And when the dollar goes down, commodities go up and headline inflation comes back up. And now you have the dynamic of higher headline, higher core, game over. You might say, but Maverick, I don't believe you. This is all bullshit. Let's go back to the first episode of the Trump presidency. So when the elections took place in 2016, everybody assumed that, oh, Trump is going to do this and that. And the dollar rocketed higher by a little over 8% or so. But when he took office and he began implementing the tax cut policies, the dollar was devalued top to bottom by more than 15%. Gee, what happens when the dollar goes down? Plug in crude oil, and this is what happens. Crude oil went from 90 to over 100. And this will happen in 25. Mind you, all of this is happening when we talk about, oh, the borrowing costs will go down, meaning the shorter end of the yield curve, the yields will continue to go down. This is why I've been saying in 23 and 24, when everybody wants to gamble in equities, okay, fine. You can keep your portion of stocks in your portfolio. That's fine. But lock in the bills. Lock in the notes for 1 or 2 years at the higher rate. That's a steal. And now the rates are coming back down. You can no longer have the 3-month bill and score a massive yield like I did in 23 and 24. But what happens with the dynamic that I just explained to you? Shorter end of the yield curve goes down, longer end of the yield curve keeps going higher. What do we call that? We have inversion of the yield curve, and we begin to steepen as the short end goes down, but rates from the higher end, the 10 to the 30, continue to go higher. That's called bearish steepening. And every time we've seen that bearish steepening, it happens under a recession. Maybe this chart is a little complicated for you, so let's do this instead. If you do the 2-year note yield and then divide it by the 10-year yield, you're going to get this chart right here. Notice the trend, okay? So every time we trend down, I'm highlighting all of these for you. Every time we trend down, we got a recession. What do we see right now? We're trending down, but we're not falling apart yet, meaning we're not seeing massive steepening yet. But that's where we're heading to. As the Fed continues to cut rates, that's going to influence the shorter end of the yield curve, but the deficit and the inflation risk keeps the longer end going higher. You will see the flush down in this chart right here, with it confirmation of a recession. Keep that in mind. Now let's segue to the earnings because that's going to influence the session tomorrow. We got Costco after the bell and comparable sales year on year, plateauing, heading down. Meanwhile, the stock is going bananas. Does it make sense? No. Costco should be going down. Am I going to short it? No, because I'm not suicidal. It is stupid. It should be down. I mean, this is not an impressive comparable sales at all. Business is stalling. But again, for some reason, they love Costco and they keep pumping it higher. So I think Costco is one of those stocks that will go down after confirmation of a recession. But the most important earnings that we got after the bell came from AVGO, aka Broadcom. Look at the revenue growth. This is the overall revenue growth. So in the latest quarter, it's 47% year on year, and the trend is still going higher, so that's pretty good. Now, if you look at the most important segment of AVGO, it's called infrastructure software. The growth here, according to the numbers that they gave us, was 200% year on year. That's an improvement from the latest quarter, which was 175%, or the previous quarter, I should say, which was 175%. So the trend is still going higher here. Now, what is that going to do? Because you look at the stock, and it was in the same period, the stock is up about 91%. But at the same time, you could say this is maybe overpricing Maverick because revenue growth is only 47%. Shouldn't the stock go down? But infrastructure software is up 200%. So what I do in these kind of circumstances, take the overall revenue growth, let's say 50%, and then take the infrastructure software, because this is the growth engine segment of the company, 200%. Divide them by 2. What do you get? 125. So the pop that we see after the bell, about 13% or so, does make sense, assuming that the numbers that they gave us are correct and there's no cooking or accounting gimmicks. Now, what happens if AVGO goes higher? Well, it's a huge weight in a lot of indices. Chip indices, dividend indices, a lot more indices. So it's going to probably lift the market higher, at least technology, in the beginning at least. And folks will speculate and say, okay, if AVGO growth is pretty good, then where's that coming from? Maybe NVIDIA is doing better than we expected, and they begin to buy NVIDIA again. At least try to buy it. So tomorrow, most important dynamic. We open higher. Sure. What happens after that? Do we fade? Most importantly in NVIDIA. Forget about AVGO. That's probably going to close positive. I'll be shocked if it does a gap and crap and closes negative. But what happens to NVIDIA? It opens higher 1-2%. Does it fade and turn negative again? If it does, it doesn't matter what AVGO does because it can go higher by 13-15% on price, the growth already, and then stall and come back down. Now, we're going to talk about all of this in the morning brief tomorrow, but let's segue here and add more color to this conversation by revisiting the market activities, beginning with the closing of the indices. And here we go. The diamonds in the red down by 234.44 points, or a loss of 0.53%. The Nasdaq in the red down by 132.05 points, or a loss of 0.66%. Looking at the S&P 500, also down 32.94 points, or a loss of 0.54%. The Russell 2000, this is the yield sensitive, of course, yields blasting higher today. So the Russell is getting absolutely hammered here, down 3.09 points, or a loss of 1.30%. Looking at the sectors, pathetic across the board. Dollar higher, metals leading the pack to the downside. Yields higher, other sectors also going down. Dividend, doesn't matter. Defensive, all down. Consumer defensives managed to close in the green because Coke and Pepsi were trading higher. Exception, at least for now. But if we're trading Coke and Pepsi based on dividend alone, if bond yields continue to go higher, even Coke and Pepsi, they're not going to be able to hold. And this is why I said yesterday in the charts analysis, hedge your dividend portfolio. Dividend stocks will be fantastic in 25 later on, but there could be a short-term pain here. So please take advantage of the low VIX and hedge. Matter of fact, all of your portfolio. Forget about just the dividend. All of your portfolio. Think about a 10% drop in the market, a 5 to 10% drop in the individual equities that you own. At what level do you want to exit? If there's a huge flush, buy your puts right there. Go for the entire quarter. Marsh. If you have redundancies, you don't need to buy in every single name. You just have to buy a proxy that represents all of them, or at least one of them, in the individual stocks. If you have redundancies, you pick one of them, that's going to cover for both. As far as the quantity of the contracts, if you want to cover one-to-one, that's going to cost you a lot. Usually we don't do that. In regular hedging, we do a percentage of the losses. We're not aiming to prevent all of the losses. When we buy the puts, we're aiming to cover for some percentage of the loss, but have the put at a strike price where we desire to exit in the case of a crash. Keep that in mind. Looking at the breadth, awful today, down 65% in the NYSE, only 33% advancing. In the NASDAQ, 68% declining, 29% advancing, so awful breadth, a different picture from yesterday. You look at the heat map, it shows you the story right away. Majority of stocks are down today. A few exceptions, so Nvidia's down. Of course, they want to pump Apple higher just to keep the indices afloat. We have Intel that got a triple downgrade today, which is usually a sign for a bottom or a sign for at least a rebound, and this is why we see Intel moving higher. The Johnny-come-lately analysts are now coming out and saying, hey, by the way, Intel is a bad holding in your portfolio. Well, thanks so much. Appreciate it. ARM remains hot, so whatever the hell is going on with ARM, it has its own dynamics. We talked about Coke and PepsiCo, those are going higher. Kroger, of course, going higher because the deal with Albertson is off the table right now. I think it's done, it's kaput. So investors in Kroger are saying, okay, we're not going to spend money to buy Albertson. That's pretty good for the equity price. And then we see Merck going higher, and I own Merck. I just bought it recently. Some of you also followed and bought it recently. Here's an interesting piece. It says, how can you earn $100 per month as a Merck investor? If you want to make $100 per month, $1,200 annually for Merck dividends, your investment value needs to be approximately $38,217, which is around 371 shares. I think it's not bad to get $100 a month from a high-quality stock with a dividend, and you're getting it at a low price right now. And $100 used to do a lot back in the day, but you're probably not going to be able to do anything with it, except maybe buying a Top Gun membership, right? There you go. Let's go back to the map here, and we see a lot of decliners. Notably, of course, Tesla got a little too hot. Google got a little too hot. UNH and the healthcare names in the XLV will remain a drag. And the unfortunate thing is, every time UNH goes down, which is the heaviest weight in the XLV and many other healthcare indices, it drags everything down with it. So it drags Cigna, it drags Thermo Fisher, Regeneron, NVO, Lilly, all of them get dragged down by the weight of UNH. So I say if you have holdings in healthcare and you want to hedge, you can buy puts on United Health, because if that name continues to go down and drag the indices down, at least you're making some money from that downside. Looking at the heat map for the ETFs, what do we do here? TLT down big, which means that yields are higher, as we anticipated before the CPI. So you're not going to see a lot of the yield-sensitive stuff working out. The defensives are holding, but they're slightly down to flat. We're talking about the XLU, XLP, IYR, real estate, but the risk-on ones are all down. You have the dollar going higher, so we see cryptos down, we see gold miners down, we see metals down across the board. We see the Brazilian ETF down across the board, the internationals, I should say. Although China is holding a little better, and think about this. What happens if the dollar goes down? If Chinese equities are holding pretty good with dollar going higher, imagine what will happen if the dollar begins to go down. This is why I think that Chinese equities are one of the best ideas in 25. But looking at the map right here, nothing is really working besides the inverse indices in the VIX today. Moving on to commodities. Crude oil down for the day, but it made an impressive comeback. Because we got jobless claims, by the way, and jobless claims came out at the highest level in 2 months. So that adds up to the duality of the risk when you have higher PPI, but you have consumer spending lower, and then you have jobless claims higher. So initially, the dollar went down, bond yields went down, crude oil went down, as in to suggest that the recession wind is stronger. But upon digesting the data, the market decides that no, the inflation wind, the inflation risk is perhaps more important. So we see the dollar firming up again, we see yields firming up again, and we see oil also firming up again, but it ran out of time to turn into positive. The party boy nat gas continues to go higher, seasonality of course, up about 3%. In softs, the three amigos remain the leader. Cocoa, OJ, coffee, although coffee is lagging today, but the dips will be bought in coffee, no doubt about it. Sugar is the weaker spot in softs. I'm not going to include it in the three amigos yet until it makes a breakout first. With the dollar going higher, metals are not going to do pretty good, so you see gold, silver, platinum, copper, palladium all down across the board. But remember what I just showed you. The dollar will go down. That's inevitable. And when it goes down, metals will be a pretty good holding. Grains going down because the dollar coming back up. When it comes to meats, I want you to look at the chart of live cattle, feeder cattle. All of these charts are breaking to new highs. So that's inflationary. Even with the dollar, folks, going higher, we still see cocoa, all-time highs. Coffee, all-time highs. Nat gas moving higher. We see OJ, all-time highs. We see some of the grains finding rallies here and there. We see live cattle, feeder cattle going higher. Imagine, folks, what will happen if the dollar begins to go down. Inflation will come back in no time with such ferocity. Keep that in mind. Moving on to the big casino options market, what do we see here? Volume is receding as we head closer and closer to the Christmas holiday. Of course, volume will catch a rebound next week because of OPEX, and then after that it recedes. So my 2 cents would say that next week we go down because a lot of calls have been accumulated throughout the post-election rally. The market maker will probably try to exercise some maximum pain on these calls. So we go down next week, and then we float higher all the way till the end of the year. And we begin a fresh new year with a new set of concerns. But any notable activities here on the table that you see right here, calls are still dominating. That's the nature of the seasonality. Nobody wants to buy hedges. So we see puts down, we see the VIX down, but that increases the risk of an accident. That if you introduce a catalyst all of a sudden that requires hedging, everybody and their mothers begin to rush to hedge at the same time. We see a big pop in the VIX, big drop in equities. That's the risk, of course. Looking at the IV ranks, we're beginning to firm up a little bit. So now you see NVIDIA at double digits, Apple beginning to move higher, Microsoft beginning to move higher. So that opportunity of hedging cheap, you're running out of that opportunity. The opportunity of buying puts cheap for January and February, you're beginning to run out of those too. Keep that in mind. Looking at the flows, bullish flows for PPR, dividend day. Then you have BA, this is Boeing, Uber, SPX, bonds, Intel, Costco, Coinbase, Meta. Bearish flows for Gilead, Pfizer, Dick's Sporting Good, Google, WMB, ADP. WMB is Williams Companies. I think that that stock is in a bubble right now. It's way overbought, so it makes sense that they're de-risking here by closing calls and opening puts. ADP is the Fugazi private payrolls data company. We got bearish flow for GLD, Gold, Apple, SPY. What about the unusual activities? Let's begin with the bullish one with a catch, because this is bullish for the VIX. Somebody bought the 20 calls, they sold the 25 calls. The expiration date is March 18, 2025. Now, with a structure like this, with an entry price of about 60 cents, it doesn't matter if the pop happens in December, in Jan, in February, in March, so long as it happens before the expiration date. The trader is aiming to score about 800 to 900% worth of gains because the maximum value of the contract will be about $5. But if you're going to buy a spread like this with December 20th expiration, maybe you'll pay a little cheaper entry price, but then you don't have the luxury of time. What happens if we see the pop happening the week after December 20th or the first week of Jan? This is why I do like this trade a lot, because it gives you enough time. The profit target is identified and the entry price is low. All in all, they paid about $3.3 million for those. Then we got Uber. Uber is down big because of this robo-taxi phenomenon, but somebody says that we have a rebound coming. They bought the 75 calls. They sold the 100 calls. The expiration date is January 20, 2025. Spending about $4.5 million. Can Uber rebound? Yes, sure, because it's still producing a lot of profits and a lot of revenue. But you need that cloud that is hovering above Uber right now of the robo-taxis. You need that to move out. How would it clear out? It would clear out if Uber comes out with its own robo-taxi initiatives. They don't have to really have anything tangible. Just bullshit your way. Come out with the CEO and say, hey, we're going to do, we just experimented with a robo-taxi. We're partnering with whatever robo-taxi boom. The cloud is gone. You can do it, of course, if the market forgets about it, if we start talking about something else, like the earnings of Uber, but that's not going to happen until next year. But you need that cloud to clear out. Otherwise, the negative sentiment right now will persist. How about Coinbase? COIN. They bought a lot of stuff here. They bought the 335 calls. They bought the 385 calls for the expiration date of December 20. Then they bought the 370 and the 342.5 calls for December 13 next week. Or excuse me, this Friday. So they're expecting a huge pop to happen really soon. I don't know what they're seeing really, but they spent about $15 million in those. Could be pending news that you and I are not really aware of, but this is a huge trade on Coinbase. Then we have ICE, International Exchange. Somebody bought the 160 calls. This is highly unusual, so they probably know something about the sticker right here, ICE, maybe a pop coming, a piece of news coming. So they bought the 160 calls, the expiration date Jan 15, 2027. So longer dated kind of play. They spent about $3 million in those. Here's another bullish one for you, really interesting, for YUMC, Yum China. Really interesting play on China because usually we go with Baba, Pinduoduo, FXI, NEO. But Yum China is a little more aggressive because you're betting on the consumer coming back. Somebody sees it happening, though. They bought the 52.5 calls, the expiration date April 17th, 2025, spending about $1 million. How about we do the bearish ones? For the Qs, somebody bought the 525 puts for two different expiration dates, February 21st, 2025 and Jan 31st, 2025, spending about over $11.5 million. So they're betting on a correction here. But of course, they're picking different expiration dates because they have a limit of 5,000 in the quantity, so they spread it out in two different dates. I think it's a rational trade. If you think we have a correction and you're a whale, as probably this trader is, they're probably also hedging some of their exposure. It does make sense a lot. How about the SPX, the cash index? Somebody bought the 5,500 puts. The expiration date is in Jan 18, 2026. Longer dated, so we're betting for a bear market here. Spending about $55 million in those. You think this trader really cares about, oh, today we got AVGO, oh, yesterday we got Apple moving up, and NVIDIA going to, oh, the day before we got a pump from this. No, they don't give a shit about any of that. They're playing the long game here, my friend, and we have MicroStrategy here, MSTR. They bought the 250 puts. The expiration date is December 27, 2024, spending about $1.3 million. So what I'm gathering here is, if you want to go long Coinbase, maybe your hedge would be puts on MicroStrategy. You see something here happening. Lastly, with yields going higher, what do we think about the IWM, the Russell 2000? Probably not positive, right? We're probably going to go down. So somebody here bought the 218 puts. The expiration date is February 21st, 2025, spending a little over $1 million. Agree with the trade? We'll look at the chart in a second. Speaking of, let's begin the charts analysis with the SPY and hourly chart. What do we see here? What we see is what we talked about yesterday, elimination of the bull flag that we talked about, and now we have a confirmation of a lower high. And that means that the momentum is rolling over. You see it in the MACD as a confirmation. Would have loved if we closed below 604.14, or better yet, closing the gap. We did not do that. Then factor in a hotter open in AVGO. We could see a rebound higher. Maybe we find some resistance at 607. But if we come back down again, and the key will be NVIDIA might pop, then fade. And we cut below 604.14. Oh, you got to double down on the puts big time. You got to go with the 600 for next week. Because if you zoom out all in all with the 30 minutes chart, do we have a trend here that began all the way, let's say, November 20th or so? Yes, we do. We're now retesting this support from a lower high. The odds would say going to break below this trend line. So unless there is a massive recovery tomorrow, the odds would say that we're going to come back down and break this trend and find support at a lower price point. You look at the E-mini futures weekly chart, bearish engulfing, so we can go heavy. We can buy the Jan and February puts. Not really, not quite yet. Hold your horses. If we get it tomorrow, we'll do it right away. Looking at the Qs, again, elimination of the bull flag. We lost 526.91, so it increases the odds that we're going to go down. But we all know what's happening with AVGO, so we're probably going to open gapping higher, maybe close the gap above. By the way, even if you're bearish, you'd love to see closing the gap above that we opened today. Because if we flush down right away and we leave that gap open, then the speculation will be, okay, we can't really sustain in a downturn because we have to go up and close that gap. So I would love if we open gapping higher, close that gap, then flush down, led by NVIDIA, and then we take 526.91, double down, triple down. You got the permission now to play a little heavy on the puts. Now zoom out a little bit more. 30 minutes chart. Do we have a trend line here? Yes, we do. Qs outperforming the SPY, of course. SPY touching the trend line already. Qs not doing so because the majority of the recent rally happened in the backs of the big caps. But again, we're beginning to see sort of a break in this trend. So your confirmation to go, let's say Jan, February, March, with bigger percentage points in your investment in the puts, you got to break that trend line first. At least you got to see the SPY doing it. And that could be a leading indicator that the Qs will be next. Now, looking at the NASDAQ futures daily chart, hitting the rising wedge, but no reversal candle yet. If we get it tomorrow, then I'll say, okay, let's play a little heavy here all the way to the end of the year. Not quite ready for Jan or February. Maybe Jan, but not February puts. We can do February if we break the trend line that I just showed you in the Qs. But if we just go down with a bearish engulfing candle, I'll probably go a little heavy for next week because we're probably going to have a hawkish rate cut by the Fed. And you combine options expiration, we're probably going to have an ugly week next week if we have the bearish engulfing candle by tomorrow, which is, to be honest with you, I don't think it's going to happen. And this is why, for now, yours truly is just sticking with some put debit spreads, some put butterfly spreads. Just test the waters. If we get confirmations, then I'm ready to go heavy. I'm going to share that with you in Discord. I'm raising a little bit of cash right now. So it can go heavy once I get the confirmation. Do we have confirmation on the IWM? Yes, we do. We lost the 20 days moving average. The assumption is we're going to retest the lower bands, 228 or the 50, 229. So we might find support there, but that could happen really fast. If we see yields going higher again tomorrow, we're probably going to reach that by tomorrow's session. And this is why I said you got to jump the gun here, but you didn't know the break is going to be up or down. So if you went with a straddle and we get a flush down tomorrow, it'll pay off. If you get a rebound, you'll feel even better. But you look at the Dixie. Are we eliminating the topping in a shoulder pattern? I think so. We're not ready to declare that officially yet because we need to actually pass the shoulder line. But the dollar coming back up, we see the old man gold now changing its mind and saying, yeah, we got a bearish engulfing candle here. I cannot rally with the dollar going higher. Give me a lower dollar, I'll go higher. And today we got the ECB cutting rates, so we see the dollar firming up. Folks, I think once we begin talking about the tax cuts of the Trump administration next year, the dollar is going to begin to soften. And at that point, gold, silver, the metals, the inflation or stuff, commodities will begin to lead the market higher. The market might actually go down because you'll see that the big caps, you'll see de-risking and profit taking from those. You see a different cohort leading the market. Now we look at this, silver lost the 50. Now the next destination could be the 100 days moving average. And this is why I said yesterday, if you're long gold, buy the SLV puts. If you did that, you got paid today. You compensated yourself from a damage that you got on your gold holdings. What about crude oil? What do we see here on the daily chart? It was an impressive recovery today because it retested half of the body of the breakout candle. And then it came back up, but it did not close above the 100. The 100 is in red, pink, whatever that is, magenta, right? If you close above the 100 days moving average, confirmation to go all in buying ExxonMobil calls. And today, it retested the lower bands, came back up, so it could be a bottoming day. Remove the bands, maybe we have a falling wedge. So I think we're getting really, really close for a rebound here. Could be a big one for Exxon. And a rebound, let's say 1%, 2%, 3%. That's going to pay you a pretty good penny if you buy the calls right now. Looking at the 30-year bond yield, we're heading higher. Elimination of the topping head and shoulder pattern, that's not going to happen anymore. Now we'll probably have a cup and handle pattern, which means that we're going to head higher. And you see the momentum in the daily chart, MACD, and now turning positive. Here's the problem, folks. Look at the weekly chart. Isn't this an inverse head and shoulder pattern? Could be argued as a cup and handle pattern. Doesn't matter how we look at it. But if we look at it from a head and shoulder pattern perspective, the breakout usually happens if you measure the head all the way to the shoulder line, or the neckline, I should say. That's going to be the point of breakout. So if we do that, the breakout would be all the way to, let's say, over 5%. You think that's not going to rattle the equities market? Think again, buddy. And that's going to devastate the XHB home builders, which lost the 100 days moving average. And I think we have more declines to come. Plug in the Bollinger Bands. That'll take us all the way down to 113.45. IYR, same thing, lost the 50, lost the 20, retested the 100 today and closed at the lows of the day, so it doesn't look good here. As the 30-year bond yield continues to go higher, both the XHB and the IYR, unfortunately, will go negative. The KRE regional banks, what do we do here? Again, it is negative. This was no surprise to us with the yields going higher, but the Bollinger Bands are really close, so if you're going to trade the KRE to the downside, you're not playing the daily chart, so you're not playing 2 to 4 weeks. You're playing more than 4 weeks till expiration. Why? Because you're playing the weekly chart. The weekly chart has plenty of room to go down. I think it can go down all the way to 59.59, but because we have the tighter daily Bollinger Bands, it's going to take more time than you think. So the expiration date here has to be more than 4 weeks. We look at BABA. What do we see here? On track for an ABC breakout. Hopefully, if we cut below 87.83, forget about it. But if we continue to go higher from this point on, yes, we're going to have an ABC breakout, close the gap, and then talk about 100 again. Then we see short covering and more piling in next year. As folks begin to realize that Chinese equities have better valuations, you know the deal. The VIX daily chart, what do we do here? Yesterday I said be careful of the drop in the VIX because that was an algorithmic reaction because CPI hedge has been taken out. Now we look at the MACD indicator, we still have positive momentum. So I think that the VIX is going to break out, folks. There is no doubt in my mind that it will. And it's going to close the gap above. But will the breakout happen in December or next year? That's the challenging question. And I think it doesn't really matter if you think it's going to happen in Jan or February. You might go with that trade that we covered in the unusual activities all the way to March 2025. Buy the 20, sell the 25. I think that's going to be a really good trade. Apple, hourly chart for the big kahuna. Topping in the shoulder, perhaps. Finally coming down, perhaps. You look at the daily chart, topping candle, but no confirmation yet. Keyword, yet. NVIDIA, since they're moving inverse to one another. So NVIDIA is now below the 50. It'd probably try to flirt with the 50 or trade above the 50 because of Broadcom's earnings in the morning. Can we lose the 50 though right away? Gap and crap. That's the number one question. Because you look at the hourly chart right here. Wouldn't it be nice if we close the gap that we opened above today? It's going to be above, of course. Wouldn't it be nice that we close the gap, then flush down, take 136 as support? That's going to be pretty much in the bag that we're going to go down to 132. Because you don't want to do it right now and then leave that gap open. Now we have to speculate as we do in the NASDAQ that NVIDIA has to go higher to close the gap. Let's just close it right now with AVGO's earnings and then flush down. The souffle Tesla, what do we do here? We talked about this in Discord that if we have an hourly closing below 417, we got a confirmation for a reversal. I mean, folks are already buying the 400 puts for Jan. I think that's going to be a rewarding trade. But technically, we don't have a confirmation yet. On the daily chart, a little too hot, of course. A little too hot, a little too high. So again, if you have January's expiration, I think the odds are with you that if it doesn't happen tomorrow, if it doesn't happen next week, it will happen between now and the expiration date of Jan 17. 400 is the sweet spot. If we go down further than that, then we can roll down. One step at a time, folks. Tulips, BTC, what do we do here? Nothing. We can't do anything here. We're stuck in a range, yo-yoing back and forth. Unless you break above my buy number, 104 or 104,000. Then I'll buy, or you break below my support, 92,055.86. Then I'll be buying puts on one of these Bitcoin ETFs. And lastly, moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? You got Friday the 13th. We got the import price index. That's going to be important, but I doubt that it's going to be a market mover. But with that, folks, again, Friday the 13th, and we have, you got to pay attention to NVIDIA and AVGO. How do they open? Do we fade a little bit in AVGO? Do we turn negative in NVIDIA? I think that's going to dictate the market action more than the import price index. But with that, folks, thank you so much for joining us tonight. Appreciate and love all of you. This is all I got for you for now. Thank you for listening. Thank you for watching. We'll be talking to you again tomorrow and over the weekend. Take care.
I put it all on the line, that's true. And you know what? It wasn't a bad beat. I wasn't unlucky. I got outplayed. I got outplayed that time. But I know I'm good enough to sit at that table.